Is buying a home still worth it? Is now the right time to buy a home? Should I wait or should I buy? If you're like many buyers right now, it seems like home ownership is slipping away. It seems especially worse for the first-time home buyer. In this video, we'll look at home affordability and some stats and some real numbers and see if it still makes sense to buy a home in today's market. One of the biggest challenges we face in today's market is affordability. Over time, fewer and fewer people are able to afford to purchase a home, and the numbers show this. Let's take a look at some quick stats. If you look at the percentage of first-time home buyers, according to the National Association of Realtors, first-time home buyers made up only 24% of the market last year. Contrast that to 20 years ago when first-time home buyers made up over 40% of the market. We have also seen the age of the typical home buyer increase. The median age of a first-time home buyer hit an all-time high of 38 years old. At the same time, the age of the repeat buyer jumped to an all-time high of 61 years old. Another interesting statistic is the share of home buyers with children under the age of 18. 73% of all home buyers had no children under the age of 18 living at home, and that makes sense considering how the age has increased. If you look at this graph, you can also see how the lines have grown apart over the past 2 decades. Buyers are still out in the marketplace. And if you look at YouTube, there are plenty of content creators saying the market is going to crash because nobody can buy a home. But that's not true. Buyers are still out there. Interest rates are high. Now, this next chart shows how the impact of financing. When you look at this graph, it shows that 74% of all buyers financed their home purchase. On the flip side, that means 26% of all sales were cash sales. Cash sales do not require financing and are not impacted by interest rates. For first-time buyers, 91% financed their purchase. For older repeat buyers, these are folks in their 60s, only 69% of those buyers financed their purchase, which means 31% of all buyers were cash buyers. This next graphic shows the sources of down payment for those who financed. It shows where their down payment was sourced. For first-time home buyers, 69% came from savings. 21% were fortunate enough to receive a gift from a relative. Now that makes sense since prices have gone up. It will take longer for a buyer to save enough money for down payment. For repeat buyers, 58% used the proceeds from the sale of their primary residence. 42% came from savings. This is an interesting chart. It shows the adult composition of first-time home buyers. 50% were married couples. 24% were single females. 12% were unmarried couples, and 11% were single males. What's interesting, if you look back at the late 1980s and the early 1990s, married couples made up over 65 to 75% of first-time home buyers. It's important to remember these stats are this way because of affordability. Demand is still out there. It's just that most buyers are being pushed aside. They want to buy, but they simply can't. This is a breakdown of the U.S. population by age. The largest segment of this chart are in the 25 to 29 and the 30 to 34-year-old age brackets. This is called the Echo Boom. These were the children of the baby boom generation after World War II. According to the U.S. Census, in 2023, the median age for first marriages was 30.2 years of age for men and 28.4 years for women. That means the largest segment of the population is at the age of a major life event. The real estate market is a life event market. People getting married, having babies, getting divorced, and passing away all create real estate transactions. Someone figured this out. Homes are unaffordable. Newly married couples cannot buy a home. But guess what? They can rent an apartment. What have we seen take place in the marketplace? We have seen an explosion of multifamily units across the nation, and we've seen it locally. Look at all the new apartment buildings across the city and in some of the surrounding communities like Gretna, Papillion, and Elkhorn. If interest rates were to drop to the 5% range, the market would go back to the craziness of a few years ago. In fact, even when rates drop to the low sixes, we see the market pick up. What are rates going to do? Nobody knows. One of the problems, and I guess I'm guilty of this as well, rates have been so low for so long, you got used to 4 to 5% interest rates. Now, when rates shot up to 7%, everybody went into sticker shock. Are rates ever going to go down to the 3% range? No. Those rates were a once-in-a-lifetime deal. Here's a graph of the 30-year fixed-rate mortgage going back to 1971. And those low rates present another problem. Some people simply do not want to give up their 3% interest rate in exchange for a 7% interest rate. The question people ask or I see online is the talk about a real estate market crash. Many people have the false assumption that since homes are so unaffordable that prices have to come down. If you're waiting for prices to crash, you might be in for some big disappointment. Remember, real estate is local. The real estate market is like any other market. It depends on supply and demand. However, the housing market is different from the stock market. When someone sells a home, they have to turn around and buy another one. You have to live somewhere. So let's say prices do take a hit. Homes are not like stocks. You have to live somewhere. So you can ride it out. That is why you need to have at least a 5-year time horizon if you're buying a home. You also need to have funds put away so that you're not put in a position to where if you fall on hard times, you're forced to sell your home. The other thing to understand is that bad news sells. These YouTube creators that talk incessantly about a market crash are doing it in order to get clicks. Will the real estate market crash sometime in the future? Probably. In order for prices to crash, supply would have to increase and demand would have to drop. How does demand drop? Watch the unemployment rate. If jobs are lost, then demand will drop. However, even when we had the great financial crisis back in 2008, when inventory in the Omaha area region shot up, we had over 5,000 homes on the market. Even when we had that kind of inventory with 5,000 homes on the market, it took longer for a home to sell. But when you look at the prices, the home prices in the Omaha area did not crash. They remained relatively flat. Omaha is not a market where you see wide variations when it comes to the economy. Our employers, for example, Nebraska Medicine, people get sick and need health care in both good and bad economies. Likewise, Offutt Air Force Base. As long as the government keeps spending money, which they're pretty good at, Offutt is going to do just fine. Can the housing market be fixed? I really don't think so. I think it's going to take time. If there was some law that could be passed to make housing affordable again, I would be all for it. Sometimes when lawmakers do anything, they tend to make things worse. In the meantime, I think you need to play the long game. It's going to be tough, but people need to make better financial decisions. That might be attending a local community college instead of racking up a whole bunch of student debt at a major university. It might mean getting a second job or maybe buying a used car instead of that new car. Let's say you have some money saved up. You have money for down payment, closing costs, and money set aside in an emergency fund. You also have a long-term outlook and you plan to be in your next home for at least 5 years. Let's apply some real numbers and make some assumptions and see if it were to be better to rent or buy. At a 7% interest rate for a term of 30 years. And then we're also going to have to pay PMI. PMI stands for private mortgage insurance. Anytime you get a conventional loan with less than 20% down payment, you'll have to pay PMI. The amount of PMI is going to vary, and it's going to depend on your credit score and the amount of down payment. In this case, we're going to calculate $235 a month for private mortgage insurance. Now, the loan amount is $284,693.88, and the monthly payment, and this is just principal and interest, would be $1,894.08. Let's say the taxes are $6,000 a year. Our homeowner's insurance is going to be $5,250 a year. And let's assume insurance rates are going to be high just to be on the safe side. Now, we're also going to have monthly maintenance. And for our calculation, we're going to use $300 a month for maintenance on the property. Our monthly house payment total, which would be principal, interest, taxes, insurance, and PMI, would be $3,366.58. Now let's figure our down payment and closing costs. We have $29,000 saved up for a down payment and closing costs. Remember, this is not including our emergency funds. We are paying a 1% origination fee. This is the cost to obtain a loan. In addition to an origination fee, we are also going to pay points. Now, what are points? Points are prepaid interest. Sometimes the bank charges points in order for you to get a certain interest rate. Maybe you won't be charged points, but let's just assume you're going to pay 1 point, which would be 1% of the loan amount. Closing costs, we're going to figure at $8,000. Now, one cost not included in our calculation is the cost to pay your buyer's agent. Now, remember, in order to see a home, you have to be under contract with a buyer's agent. Now, compensation is negotiable. However, when you purchase a home, you can ask the seller to give you a seller credit to pay for the cost of your agent. So our total down payment would be $15,306.12, and our total closing costs would be $13,693.88. Now let's jump on Zillow and find a rental. This is a 3-bedroom, 2-bath with over 1,700 finished square feet, and it's rented for $2,350 a month. Looks like a really nice place. So our monthly rent would be $2,350. And then we're also going to calculate if we didn't buy a house and we had that money invested, we would earn a return on those funds. Now, in this case, we're going to look at the S&P 500 over the past 20 years, and that yields about a 7% return. So our after-tax investment return, we're going to calculate for 7%. And then we also have to figure an income tax bracket. We're going to say we're a couple and we're at the 22% tax bracket, which means we're married, filed jointly, and we would make between $94,000 and $201,000. We also have to anticipate inflation. In this case, we're going to calculate inflation at 3%, and then we're going to make the assumption that homes are going to appreciate at 3%. And then also down at the bottom, you see a box where it says other, and then we're going to put in 5%. What we're going to do here is the reason why we put in 5% is, let's say if we have to sell, let's say that is going to be the amount that we get charged if we hire an agent to sell the property. Again, commission is all negotiable, but we have to put a number in here because it's going to make a difference on when we break even. In this case, if we were to rent or if we were to buy, your home purchase would break even in approximately 6 years. And that's including an agent to sell the property. If you didn't have to use an agent to sell your property, then your break-even point would be 2.8 years. But with that 5%, then you're looking at a break-even point of 5.7 years. This is your 10-year projected monthly payments. Now, starting out, your net house payment is going to be more than your rent. But as you can see, starting around year 4, your rent is actually going to be higher than your net house payment. And then when you go out to year 10, you're going to see that your monthly rent would be $3,158 versus a net house payment of $2,745. Remember, principal and interest payment are going to stay the same, and then your taxes and insurance could increase over time. So that's why you're going to see that net house payment increase slightly. So in this case, your home purchase break-even point is approximately 5.7 years. Here's the thing. We don't know what the inflation rate is going to be. We don't know what the appreciation point would be either. If you were to change just one of these numbers, let's say your home appreciates at a 4% interest rate, a 4% appreciation point, then your break-even point goes down to 3.8 years. And it could work against you too. Let's say prices stay relatively flat and home prices only appreciate at 2%. Then you're looking at 9.5 years before you can break even. And it can work against you the other way too. Let's say you're not very good at picking your investments in the stock market. And let's say you only earned a 4% return after-tax investment return, but your home appreciated at 4%. Then your break-even point would be 3.3 years. So it's all going to depend. Nobody knows for sure. But in the long run, if you have the time, you're probably better off buying than renting. But in the short term, you're better off renting.